It's been about 1 week since the election. Donald Trump was elected next 47th president of the United States. I want to talk about the bond market. In general, I think this administration, this upcoming administration, is going to have a massive impact on the economy one way or the other. And here's why. First, we had a terrible 4 years of economic management under the Biden administration, I think partly driven by the COVID inflation that was driven by a lot of spending of government money and very low productivity, particularly in the government sector, but also in the private sector. So this culmination really led to a very sort of sluggish economy. Small business sentiment is very, very low. The only thing that is helping us stay optimistic, at least here in Silicon Valley, is the massive innovation in AI, which is driving, of course, the sort of next wave of growth in the economy. Now, what the Trump administration needs for the bond market specifically, and then for the general financial market broadly, is, in a nutshell, a massive reduction of corruption. And by the way, when I say corruption, I mean two types of corruption. The classic corruption, which is under table money, you do me a favor, I do you a favor, that kind of thing. But then also generally corruption just being sort of, government employees working instead of 8 hours, only 3 hours a day. Some jobs just being no-show jobs. Like a lot of that inefficiency in the government that is, bloating the government and really not just making it more expensive to run the government, but also making it much slower and therefore making running businesses more expensive. The tax on U.S. businesses through the inefficiency of the government, in my opinion, and this is just a gut feeling, is worth at least 200 basis points in the interest rates. In other words, if we succeed in cutting down the bloated government, this will be an equivalent of maybe 200 basis points cut in interest rates. I'm going to elaborate what that actually means and why there is this relationship between interest rates and government corruption, and also I'm going to elaborate what that means for the market. But what I want to focus on here is really the opportunity that we have as a nation, as a society, but also as investors here to really sort of step into the future by having a more efficient government and therefore really liberating our economy in terms of tax on businesses and individuals that comes with an inefficient government. So that's I would say that's the first thing. And second, it will also free up financial, let's call it financial tax. So in other words, interest rate or the equivalent of a higher interest rate on the financial economy because of the bloated government. So both of these things are very Goldilocks. They're very good. And they're driven by Donald Trump as president. They're also driven by people like Vivek Ramaswamy and Elon Musk, who are actually heading up the Department of Government Efficiency, DOGE, and who have set themselves a goal to, for 18 months, so they give themselves 18 months to reduce $2 trillion in government spending. And that is financially incredibly important as far as deficit cuts are concerned, but it's also symbolic, and it's also freeing up regulatory overreach, which is slowing down businesses. So overall, this Goldilocks environment should lead to the following. It should lead to, we expect up to 3% of real growth. So for example, 4% nominal growth, 1% inflation. It should lead to a steep yield curve, so low short-term rates and higher long-term rates. It should lead to high real wage growth, relatively high real wage growth, and it should lead to deflation, particularly in sectors that are currently burdened by inflation. This is an Not Even Wrong podcast. It's November 13, 2024. This is Crimdelco. For the day, the fund is down 8%. The market is down 0.5%. For the year, we are up 53.4%. The market is up 24.4%. We're outperforming by 29%. We have a little bit of a correction in Tesla, particularly. The stock has been very volatile since the election. since the election were up roughly 25%, maybe something like that. So we're still incredibly outperforming, of course, the market and everything. But there is some correction. I think the volatility in the Tesla stock is driven by several factors. One is the hope that the regulatory capture will decrease, and therefore Tesla will have better opportunities, in particular in launching unsupervised FSD. On the other hand, we have the reduction of the EV tax credit, and we still have high long-term interest rates. So those are two negatives that certainly will weigh on the stock. I think overall we should have a halo effect also, more demand for Teslas, maybe margin improvement a little bit, and the opportunity for unsupervised FSD launch within the next 6 months should definitely support the stock going forward. But now let's talk about this situation that we're in right now with the election of Donald Trump. And whenever it comes to the bond market and the economy, the problem with that is always there's several factors. There's always multiple factors moving in different directions, and it's relatively complicated to have a very clear-cut explanation of what's going on. So I'm going to make an effort here to be as clear as I can without, of course, cutting down too much and making it sort of not realistic. So let's start with the goal. The goal under the Trump administration is to cut government spending and to cut the deficit and to deregulate the economy. So those are three goals that are all encompassing one overarching goal, which is reduce government corruption. Trump has put Vivek Ramaswamy and Elon Musk in charge of this particular task. There's even a Department of Government Efficiency. Now, whether that department is going to be like a department like the Department of Defense or something, or whether it's just a temporary one, we'll see about that. At this point, self-proclaimed, the department is there only for 18 months. So this is a special situation. Think of it like a task force, like a SWAT team that goes in, cuts, and then gets out. What's the goal? The goal is there's three things that this department is aiming to achieve. One is to reduce the government apparatus. So this first goal is not yet the financial goal. It's simply what is the mission, what do we need, and who can do it the best. So those three things, those three questions will be asked department by department, agency by agency. And the goal is, of course, to cut a lot of slack. So, for example, like Vivek said in one of his presentations about this particular topic, take the Department of Education. The mission of the Department of Education is, when it was inaugurated, I think in the 1960s, is to make sure that there's no systemic racism in the South because of the civil rights movement and the end of separation of black people and white people in schools. I think there's a word I forgot. So the end of that increased the fear that there will be racism against black people in those types of schools. So the Department of Education, which was a federal agency, had as a goal to make sure that doesn't happen. So that's the mission. It's a laudable mission, of course. And what this new department, the DOGE department, will do is it will go to the Department of Education, line by line, employee by employee, and say, okay, what exactly are you doing? Are you working towards that mission, or are you doing something else? And if the answer is I'm doing something else, you're going to be cut. And my hunch is because, of course, this mission today is, probably still makes sense in certain cases, but I'm pretty sure that the budget of the Department of Education is way, way higher than what is required to fulfill that mission. So we're going to cut all of basically the whole, 90% of the budget, or maybe we're just going to close down the department like Trump said. Now the same thing is going to be department by department. So, Secretary, Department of the Exterior, Department of Interior, the Labor Department, all of these departments will have the same type of process. And the goal is really to make sure that that there is a clear that there is an alignment between the mission of the department and the excuse me, I'm just driving here. So there's an alignment between the mission and what actually people are doing. So this would be the first goal. The second goal is to reduce government spending. So that, of course, the first goal will automatically reduce government spending, but there's more than that. We can also look at, for example, even if a certain, department is doing what it's supposed to do, but is it doing it very efficiently? Is it a cost plus model where they pay consultants and overpay for services? Are they getting the best deal in the market for whatever they need? Are they getting the best IT? Are they using AI properly? So those are things that are more business driven and financial. This is like a company, let's say, when you restructure a company, you make sure that they get the best deal in terms of rent, they get the best deal in terms of cloud computing and so on and so forth. Again, here we know anecdotally, let's say from companies like Palantir, that's certainly not the case. In other words, government agencies are way overpaying for services, and to some extent that is because they're not interested or they're not incentivized to get the best deal. Sometimes there's corruption because they give on the table money to their friends who sort of provide them services at high rates, and then there's the revolving door where they get to then go work in those companies. So that is, of course, an incredibly important function also. So that is the second goal. The third goal is to reduce the regulatory overreach. Now, the regulatory overreach is the stuff that Elon Musk was talking about. Let's say the kind of harassment that he had to endure with SpaceX. Those kinds of things need to be reduced, and that is to some extent also a financial goal, but it's more of a sort of, I call it fundamental goal, right? So if you're a business that wants to open a factory in California, instead of waiting 3 years for paperwork, it should be only 20 days. If you want to hire an engineer from India or from Bulgaria to do your software development, you should wait not longer than maybe 20 days for an H-1B visa. It doesn't mean that she automatically gets the visa, but you should get the decision at least within a reasonable amount of time so you can make planning. So this kind of deregulation is the third goal. So if we have to summarize those three goals, number one, reduce the number of departments. Number two, make sure that those that remain are efficiently run. And number three, make sure that they don't overregulate, that they don't overreach, that they do what they're supposed to do, and that they have the minimum amount of regulation necessary to fulfill the task. Now, how that can be done, of course, that is, there's several ways to do that. I think it's been done many times before in business. Musk has done it in his own businesses several times. Vivek has run a business. He should know how this works. And there's plenty of know-how that they're actually now crowdsourcing, also hiring people. Actually, I myself, I'm applying for a job at DOGE also. I think if you have enough smart people, if you have enough dedicated people, if you have enough motivated people to help implement this, then this can be done really efficiently. So why is this now important what does this mean for the financial side of the economy? And then I'm going to talk about also what it actually means for the economy. But let's talk about the financial side of the economy for a second. So the financial side of the economy, what I mean by that is things like the bond market, the government deficit, inflation, those kind of things. The things that financial economists talk about. Now, if we can reduce the government budget by $2 trillion, we should have a government surplus, because right now we have about $1 trillion of deficit. So if we have $1 trillion of deficit, and we reduce by $2 trillion and make everything else equal, we should have $1 trillion surplus. Now, I don't know whether that's realistic or not, but let's say we can balance the budget. Let's be aggressive in one way, but even conservative in another way. Musk and Vivek are talking about $2 trillion. Let's say we just balance the budget for a while. And by the way, let's keep this for a while. So a couple of years, at least 2-3 years, balanced budget. That means there's no new issuance of bonds. That means that with a balanced budget, we can also start reducing the debt, or at least grow ourselves out of the debt because we have a balanced budget, so we're not adding to the debt, and we might still have debt, interest payments and all that, but at least we're not adding to the budget. So if that's the case, what we expect, this is an expectation, please read our disclaimers, and this is no investment advice whatsoever. Do your own work. This is a pure expectation that with a balanced budget, we will have a steepening of the yield curve and an absolute reduction of interest rates. Now, what does that mean? Let me walk this through very carefully for people who are not familiar with the bond market. First, let's talk about the easier one. We would just have relatively lower interest rates. That means that, let's say, the 2-year yield on the Treasury will be lower than today. The 30-year yield on the Treasury will be lower than today. Mortgage rates will be lower than today. Auto loans will be, everything will be lower. Why is that? Well, you can think about it in more complicated ways, more simple ways. It's up to you. I'm going to give you the simple explanation, and I'm going to give you the little bit more technical explanation. The simple explanation is the following. If one big player, i.e. the government, is not asking for money, then there's more money left for other people. And if there's more money left for other people, then the price of money, which is the interest rate, should come down. And that's the easy explanation. The more complicated explanation would be that you have less issuance of treasuries. With less issuance of treasuries, there's more room for other people to issue bonds. Companies can issue bonds, and humans can, normal people can issue bonds or get mortgages, which is the equivalent of a person issuing a bond. And again, related to the first explanation, it's just that we have this one big player, the government, which is not in the market anymore as aggressively, and therefore there's more room for other people to take advantage of credit. And since the government has a soft budget constraint, so they can, they under Biden basically had a free for all, they could spend as much money as they want. This pressure will really, it's kind of like you have this pressure cooker, and now you take this pressure out of the system, and it's just going to be relief. Now, so that means we're going to have in absolute terms lower interest rates across the yield curve. Now, what is the yield curve? The yield curve is the difference between short-term interest rates and long-term interest rates. The way the American system works is that we have short-term interest rates, which is the Fed funds rate, which is a one-day interest rate, and it goes all the way to 30 years. And the reason we have this yield curve is because different people, different businesses have different requirements for different maturities of debt. If you're a business and you're buying inventory that you want to sell in the next 6 months, then you need to borrow money for about 6 months. If you're a business that builds a factory, you probably need money for 5 to 10 years. If you buy a mortgage, a 30-year mortgage is typical in the United States, because you're buying a house, you're going to be there for a long time. Your kids will inherit the house, so it's okay to have a long-term debt on the house. So there's different types of necessities the people need money for different purposes with different maturities, and that's why we have different maturities, and that's what the yield curve does. The government borrows money at different maturities, so there's treasury bills, usually 1 week, 1 month, 3 months, 1 year, 2 year, and then the treasury securities, which are more like 2 year, 5 year, 10 year type of maturities. Now, the yield curve is the difference between short-term and long-term. Typically, in an economy that is growing, in a healthy economy, let's say, imagine an economy like Singapore or Switzerland, like healthy economies where there's very little corruption. Most of the economy is driven by the private sector. We have sort of an Austrian economics type, macroeconomic management. It's sort of based on human action. It's more organic. There's very little corruption, et cetera, et cetera. You will have an upward sloping yield curve, which means that the short-term rates should be lower than the long-term rates. There's a couple of reasons why that's the case. I think I'm just going to give you the very simple reason for that, and that is the following. I think if you have a growing economy, a healthy economy with good real returns, that means that you make a certain amount of return, and then minus inflation, you still have something left, and there's not a lot of taxing and things like that. So you really have money for yourself left. So in an economy like that, what you're going to want to do is actually invest in real businesses, in real growth. You're going to try to either buy equity in the stock market or invest in your own business, or buy corporate bonds and things like along those lines. You're not really incentivized to give money to the government because you have a productive economy, and the productive economy will generate higher returns. Which what that means is that the government will also have to pay a little bit more for long-term debt. The reason the long-term debt is going to be higher than the short-term debt is because in the short run, you have a little bit more supply of money. People in the short run, let's say a business just sold, you just sold a part of your business, and you're waiting maybe 1 year to reinvest the money. Well, you could park that with government money, which is risk-free. So if you have if you have a lot of growth, a lot of opportunity, a lot of optionality in the economy, then it's conceivable that you're gonna be more inclined to lend money to the government in the short run and less inclined to lend money in the long run, and that leads to the steepening of the yield curve. So this is what we expect. We expect a steepening of the U.S. yield curve, which we've already seen a little bit in the last couple of days. Right now the curve is flat, but it was downward sloping, so it kind of steepened in that way. But it's flat. We expect a steepening. So what we expect now, and this is now the conclusion to this whole episode, is assuming that DOGE succeeds, assuming that the first three things that I discussed in this episode, so the idea that we have a reduction in government departments, and more efficient departments that remain, and the reduction in the regulatory overreach and more efficient regulation. In an economy like that, we expect a steepening of the yield curve. We expect the effect of all those actions to be equivalent to about 200 basis points of interest rate cut. Right now, the short-term rate's at 4.5%, so that will be 2.5%, and then we shave off another 0.5% because we are coming out of an inflationary period that is going, and we're going into a deflationary period, and therefore we expect short-term rates in a, let's say, 2 to 3 year period to be 2%, and we expect the long-term rates to be more like 4%, maybe 3.5%, 4%. So we expect a steepening of maybe 1 to 150 basis points between the short-term rate and the long-term rate. This is an expectation. In a scenario like that, we expect a very, very strong equity market. We expect asset prices generally to do well, maybe with the exception of gold. And generally, commodities probably will suffer a little bit also because in an environment like that, the dollar will strengthen, and most commodities are priced off the dollar, so that will be a little bit negative for them in dollars. But overall, we expect strong asset prices. Now, when I say asset prices, I mean productive asset prices. It doesn't include housing. It doesn't include gold. So all these assets that really are more there for savings and safety, they will relatively underperform the growth assets. So this is the Goldilocks, of course. Again, there's many reasons why this could go wrong. World War III, DOGE doesn't succeed. A lot of things could happen. But if where the trajectory that we're on right now with the economy and with Trump and the administration and the goals that he's setting for particularly government efficiency are such. The last thing I want to say, just as a sort of addition to this episode, is that inflation is always a monetary phenomenon. I think this goes back to Milton Friedman, and I don't want to discuss this in particular now because I think this requires a whole other episode. But what I want to say is the following. If the government wastes less money, if we have a more efficient government, we will have a reduction in inflation, which is also, of course, a huge boost for the economy. Inflation hurts everybody all the time, so there's nobody who actually can take advantage of the inflation except, of course, the government itself. And if we make the government more efficient, then there's nobody else who can take advantage of inflation. Therefore, we'll have less inflation. With less inflation, we have lower rates, a steeper yield curve, and more growth and more prosperity. Thank you.